The GameStop short squeeze that happened earlier this year, I got to tell you that I never expected to see anything like that in my life. We've seen some short squeezes in the past, but this one just had tentacles that was far-reaching and create some big questions about investing principles altogether. One of them is, does this prove markets are inefficient and can be manipulated? Interesting question. I've got some consideration coming up. My name is Mike Bernard. I am the host of The Wise Money Show. I'm also one of the certified financial planners right here at Corhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So the Wall Street Bets subreddit forum and group, I mean, what they did was pretty unprecedented. And I tell you, when they were fighting against hedge funds and created the short squeeze, if you're unfamiliar with all of that or some of those details, I mean, we've done a couple shows on that. I've done some next wise steps on that, so check out those other videos. I'm not gonna get into all the details here, but it's created some big questions on Wall Street and really about investing altogether. And one of them is, you know, should they limit the amount of short interest out there on a stock? I mean, just in case you weren't aware, there was 135% short interest on GameStop. To me, that should be illegal, number one. Number two, should they have some sort of measures in place to make sure that apps like Robinhood and some of these others don't sell your data? Those are free apps and they lure you in with a free stock and all that stuff, but they are selling your data. You're trading data to these big hedge funds. I mean, that is criminal. It smells criminal. Should that be allowed? And then, of course, there's the big question of Robinhood and several other platforms shutting down trading so that people cannot trade as. And I know they stated their reasons, but it certainly smells like they were doing that to protect hedge funds. And so there's big questions about sort of some fundamental pieces of investing and being an investor that this thing has dusted up. One of them to me though is, do you believe in investing in just index funds or actively managed mutual funds? And that question is kind of based on this idea, and it's a little geeky, so just bear with me, but are markets efficient or inefficient? And really the question to me is what happened with GameStop, does this prove that markets are inefficient? And you can't trust markets, they can be manipulated, so you know, be on your guard. So this idea, if you haven't thought about this before, it's basically a spectrum. And the idea is is all publicly available information reflected in the price of a security at any time. So anything that could be known, once it is known, is it automatically, instantly reflected in the price? Or is it not? Are there pockets, are there bubbles where all of a sudden some information's out there and you can jump on a stock early? Like you can hear some news, not make an opinion, not draw a conclusion about something, but you can hear some news and you can jump on it early and get into the stock, get into the investment, get into the mutual fund before all of that data is reflected in the price. And most people, and the data seems to suggest that, yeah, I mean, insider information, that is not reflected in the price. And that's why there's all sorts of laws and rules about sharing insider information, not trading on insider information, because it's not already reflected in the price. But as soon as information's made public, there's all sorts of data out there that says markets are efficient. It's an extremely efficient way of pricing in different assumptions about all relevant information that's out there. So then how do you reconcile GameStop? Because was GameStop a small cap company on Monday, a mid cap company on Wednesday, and a large cap company on Friday? Is that accurate? Is that the truth? Are markets efficient, or does this prove that they're inefficient, that pockets and bubbles can be created? I would argue I would argue that GameStop reveals that markets are still mostly efficient. Mostly efficient. So on this spectrum of they're absolutely efficient or they're absolutely not, there's a lot of gradation in between, and I would argue they're mostly efficient. And that's, I say that not with hindsight as 2020, because we still don't know. A year ago GameStop was trading at $11 a share. Today, depending on when you're watching this, as I'm recording, it's still $50 some a share. So the stock price still has not come all the way back down to where it was. But the big spike, if you look at the chart, it being bid all the way up to 450 and coming almost all the way back down, that was inevitable. That was inevitable because, in my opinion, markets are mostly efficient. There was not evidence, there wasn't a basis to support GameStop being a $10 billion company or whatever it was. Currently it's at $3 billion. It was at $1 billion. So that was not going to last because markets are mostly efficient. Over the long term, valuations actually will matter. And there was no way GameStop was going to stay. There wasn't enough, there couldn't be enough buying activity, buying interest to keep GameStop at 450 or 550 or 650 or keep it up that high for a long period of time because markets are mostly efficient. So how can you explain what happened? Well, if every single day investors are buying and selling, making buying and selling decisions based on all known information that's out there. And the simple fact that one person thinks Apple is a good investment at this price and other people say I'd be willing to sell Apple at this price, that helps make markets efficient, right? And if you get enough people, markets work efficiently because you've got enough people that say, I would like to buy it at this price, I'd like to sell it at that price, and people are on opposite sides of the trade, and that makes markets efficient. But if you get enough people all concentrated in one area, and then they can move markets in the short term. But eventually the long term, that won't last in the long term. That's why there's this big speculation right now about could we be in a bubble? Is Tesla in a bubble? Is Bitcoin in a bubble? At times, individual investors are willing to pay more or willing to behave a certain way for a short period of time, right? That doesn't necessarily mean markets are inefficient or are fully susceptible to being manipulated. I would argue it means that that's smooth functioning of the markets. Believe it or not, it actually is. Now, people willing to take that risk, I believe that's Fed manipulation. I believe, there's a lot of speculation going on, people being willing to take that risk. However, the simple fact that it occurred, that's no problem to me. That's no problem. I think that still proves markets are mostly efficient. How does this boil down to you? Well, this is whether you've thought about this or not, this is a fundamental question in your investment approach. And I would urge you, if you're not working with a certified financial planner, I'd urge you to do that so you can talk about, well, are markets mostly efficient, so I should just buy index funds and just ride through it up and down? Or are markets not efficient at all? And actually, I can have a hunch that, that Microsoft is going to pummel Apple and therefore I should buy Microsoft and sell Apple. You've got to have that discussion with your certified financial planner because that's going to inform your philosophy and your approach in your investing, okay? We would argue markets are mostly efficient and therefore you should own a basket of index funds. And yet at the same time, we also know bubbles and momentum exist. We absolutely do. We've seen that time and again. We will continue to see that time and again. I have no idea if this looks like a bubble, feels like a bubble, smells like a bubble. I have no idea if it is a bubble, right? And so, but to us, the momentum exists in the markets, and bubbles can be created even in efficient markets. So you should complement that index approach, that efficient approach, with a momentum strategy, so that if all of your eggs start moving in the same general direction, if all of those baskets start dropping at the same time, you've got a momentum strategy to adapt and adjust to the changing momentum of the market. So that's the strategy I would recommend, we'd recommend that you employ, all connected to your overall comprehensive financial plan. If that's not the approach that you're taking, you can always contact us, find us online, corehorn.com. That's corehorn with a K, or wisemoneyshow.com, or just send us an email, info@corehorn.com. All right, there you have it. Go out and take your next wise step in your financial life.